Let's bring back Marley into the conversation and welcome in our next guest. Very pleased to say we are joined by Sonali Basak, who is the Chief Investment Strategist at iCapital. It's so nice to see you, Sonali. So how are you and your team over at iCapital thinking about the government shutdown and the impact on the markets right now?
You know, what you said before was absolutely correct. It is very typical to see volatility going into a shutdown deadline, but typically, historically, the market really has recouped any losses very quickly. Now, when it comes to economic data, this is clearly the area where investors are looking very hard at the private data, the ADP data that came out this morning because of worries about not receiving that non-farm payrolls report in a timely manner. Now, the length of a shutdown matters a lot here. In fact, the reference week for that survey, the household survey for that NFP print would be through the week of October 18th. So if we don't have that in time, if we still have that shutdown lasting longer, which by the way, we don't believe that it will, then it would not only impact the print that we have upcoming, it really throws a lot of water into how investors are able to assess the true strength of the labor market, given that the ADP data is a smaller subset of the total addressable market here in the United States for payrolls overall. So we would say, of course, it's never great to see the labor market weakening. It doesn't look good for the economy, particularly this morning. The change that we saw in the ADP data was, of course, a negative reading. We saw fewer jobs, particularly in smaller and mid-sized businesses. But without that NFP report, we don't feel confident to get that healthy read of the overall labor market. With that said, we're watching the bond market really closely because investors are reacting, and they're reacting without a full and complete set of data points here that would otherwise come from the U.S. government.
Sonali, you've got Marley here now. I want to focus on this ADP data since it might be the only data that we get before the next Fed meeting. Now, we had a guest on the show yesterday who called into question his opinion of ADP data was not particularly strong. And this is showing, a continuingly weak labor market in terms of the data we got today, significantly below expectations, biggest drop we've seen in 2.5 years. How, if at all, do you think that this affects the Fed's actions in October and then potentially in December, since you noted that we could see some further delays with any of the labor reports we get, depending on how long the shutdown lasts for?
Just because investors are not getting the data doesn't mean that government officials will not be able to get a good read of the economy. So now we do believe that the next two Fed meetings are live, but we do expect that October would signal a rate cut. And this is for two reasons. You are clearly still seeing a weakness in the labor market. Now, how much weakness is the big question. The Fed Summary of Economic Projections believes you can get to an unemployment rate of 4.5%. But when it comes to payrolls, which again, we may not get this month, or at least this Friday, rather, you still have things in line with where the Fed sees the direction of travel going. They're not really watching necessarily for that overall unemployment rate, given the supply side of the story in the labor market only. They're also watching the overall level of payrolls growth. So with that all said here, I think it's really important to realize, yes, we have a lot of confusion around the labor market right now, data or no data, by the way, but we do have some information about inflation. And what we do know about inflation is that core PCE at 2.9% is still below the Fed's Summary of Economic Projections at 3.1%. And what that would imply is that there's room to cut. Now, the market is pricing in currently 2 rate cuts through the end of this year. Whether we get 2 is a real question because we believe the next 2 meetings are both live. We still think that you can get that October cut, but what about that December cut, especially with the equity market at this level? You look at the trade today, for example. Yes, you see healthcare stocks rising. You see real estate rising. That's pretty rate sensitive there. There are a lot of parts of this market that are quite rate sensitive. You think about the run up we've seen in the Russell 2000. So we believe now, more than many parts of the last year, that rate sensitivity in the market is going to matter a lot at these valuations to help drive the market higher from here, given, as you said, we've hit 6,700 for the first time. We believe that we would get there this year. We just didn't think that we would get there that fast. Now, heading into earnings season, I think that's where you can hop a little bit away from the macro to look at the micro a little more, and perhaps that could create more juice. But heading into that earnings print here for most of corporate America for the third quarter earnings report season, you really have to ask yourself, how high are expectations, and are they so high that even strong earnings might make it difficult to get much, much higher from here, or at least stop the choppiness that you would see in October typically?
Yeah, I mean, we had an uncharacteristically strong September, really defying what is typically some seasonal weakness there. So on equities then, Sonali, what is your outlook when it comes to October? Because you are anticipating some volatility on the horizon as we get really into earnings season in the next couple of weeks.
Yeah, if you think about how remarkable it's been, even with all the headline risk around a government shutdown and whatnot, you did see the VIX headed into September, heading into October, remarkably low. So yes, of course, volatility could be expected. We've seen a really major run up. It's not surprising here to see any pullbacks. We think they'll be limited. Now, we think that the financials will really kick off the earnings season in a very interesting way here, because with all of this going on, you have seen the yield curve at a level that has remained quite steep, or steep enough to make investors happy and comfortable about both the loan growth you're seeing in all the economic data that's coming out, and all the data that's coming out about loan growth. You can see money made there. You've seen big IPOs come back. You've seen debt capital markets remain strong. That is all money for the banks. Now, with that said, the question is, how strong will trading results be? I would also say, and the thing that my team and I are preparing for, you've seen a lot of deal announcements recently. Banks typically make money off of the deals that are closed, which means all the deals we've seen of late, they're probably not clocking the fees for those deals yet. But that does mean that's future money down the road. So we don't think that everything is baked in yet. We think that there's more room for the banks, albeit we would hope to see that credit quality holds up, because in this earnings season, we are also watching closely for the health of the consumer. There have clearly been a lot of concerns about a K-shaped economy, lower income consumers, and really the rubber hits the road there, not only just for retailers, but also for banks, particularly smaller banks that might be more exposed to low income consumers at a time where people are getting more concerned about the labor market, are getting more concerned about the ability of what is a larger portion of the population to spend. Now, the low income consumers don't account for as much of PCE as the top 10%. But with that said, we are watching closely for credit quality in particular.
And Sonali, with all of that said, as we look into coming into earnings, expectations to be rising close to 8%, in terms of the third quarter. But with the choppiness that we've seen and these continued rallies, hitting another high on the S&P just today, do you think with the valuations where they stand that we can sustain this upward momentum that we've been seeing? And can the market just continue to keep shrugging off these major events?
In conversations with clients and other investors, I've got to say, there has been a tremendous range of views here. Everything from, are we in 1999 all over again? Can we sustain this market top? To, we could be at the beginning of a new cycle here where we see a lot more growth from the biggest of the big companies in the United States, because you haven't really seen the effects of artificial intelligence play out through the course of corporate America. So those are two widely different views. Now, with all of that said as well, what really stops the rally from here, that's yet to be determined. I've got to say, one thing that's been encouraging just in the past couple of days is that you've seen those yields come down once again. I think there was a lot of worry in the market about a decoupling. If you see lower or shorter term yields decline, whether you'd see longer term yields rise anyways. We certainly saw that last year after the last rate cut. You saw the 10-year yield still take off quite meaningfully from there. But again, we have hit that 4% lower bound, if you will. We are now back at 4.1%. We were drifting closer to 4.2% last week. If you can see that continued momentum in the 10-year yield falling, there is a lot of promising signals in there, because you could see that mortgage rate continue to decline on the heels of that as well. That could have serious implications for the mortgage market, the housing market in particular. Unclear all the ways that will shake out in the economy, but it's better to see it fall than rise. And if we saw it rise materially, we would be watching for that 4.5, 4.6% level. Once we get to those levels, that's the place where you would expect more spillover to the equity market. We're not really worried about the 10-year at these levels, but if you saw them rise well above 4.5%, we would be having a much different conversation.
Yeah, it could certainly put a lid on things, couldn't it, Sonali? It's been an absolute pleasure. We have to leave the conversation there. Thank you so much for joining us on the Schwab Network. Sonali Basak from iCapital.